Welcome to Iron Financial. This is the channel where we help you forge a stronger portfolio, cut straight through the market noise, and ultimately build ironclad wealth. I'm your lead analyst, and today we're doing a complete structural explainer and teardown of Take-Two Interactive Software's Q1 fiscal 2027 earnings report. Look, if you're serious about your investments, you need to hit that subscribe button right now, because this company is standing at a massive historical inflection point.
Right, and I'm the market skeptic. I'm basically here to represent you, the everyday investor. And I'll be asking the hard questions today. We need to know, is this stock really built on a solid foundation, or is management just feeding us fragile hype? Take-Two has literally the biggest game in history on the horizon. But as you'll see in this explainer today, there is an immense amount of heavy lifting required between now and launch day.
So, to truly understand the sheer scale and the stakes of this earnings report, you really only need to process one single number: 230 million. That is the number of units Grand Theft Auto V has sold worldwide since it was released. It is an absolute titan of the entertainment industry.
Yeah, that number is just mind-boggling, but, it also sets a terrifyingly high bar. The entire market is practically holding its breath right now for Grand Theft Auto 6. So the core question we really have to ask today is, can the rest of Take-Two's portfolio structurally support the company's massive valuation while we wait for that singular monumental catalyst? Let's break down the actual numbers they just reported to Wall Street.
Section 1. Headline versus financial reality.
Okay, when you read the corporate press release, you're going to see one story. But when you dig into the structural integrity of their actual balance sheet, the narrative completely shifts. GAAP net revenue came in at $1.53 billion. That's up 2% year over year. And sure, that's the shiny headline management wants you to focus on, but the actual cash momentum and new demand coming through the door, a vital metric known as net bookings, well, that was $1.39 billion. That actually represents a structural decline of 2.6%.
Wait, hold on. So revenue is technically up, but their actual bookings are down? How does that even work? Are they just riding on past success to kind of mask a weaker current quarter?
Exactly. You hit the nail on the head. GAAP revenue accounting includes deferred revenue from games and life services that were sold in previous quarters. So, for example, when a player buys virtual currency, accounting rules often dictate that the revenue has to be recognized slowly over the estimated life of the player. Net bookings, however, that is the true operational gauge for a gaming company. It tracks the raw, upfront cash that customers have committed to right now. So while that deferred revenue paints a rosy picture of a 2% gain, the actual current demand contracted by 2.6%. The underlying momentum is absolutely slowing down.
Okay, that definitely explains the illusion on the top line, but what about the bottom line? Because Wall Street consensus was projecting a 33-cent profit per share, but the actual result? An 18-cent loss. I mean, I have to push back really hard here. How does a projected 33-cent profit just collapse into an 18-cent loss? A 51-cent earnings miss is an absolute crater. What on earth happened to their profitability?
That 51-cent miss is the ultimate stress test failure for this quarter. Seriously. When a company misses by that wide of a margin, it tells you that their internal forecasting and their operational cost controls are completely misaligned. To understand exactly why their profitability cratered so violently, we need to look under the hood at their core expenses.
Section 2. Cracks in the armor.
We are seeing severe margin compression and pipeline failures acting like literal rust on Take-Two's financial framework. Back in Q1 of last year, gross margins sat at a very healthy 62.8%. But this quarter, they collapsed by 5.3 percentage points, dropping all the way down to 57.5%.
Yeah, when you miss earnings by 51 cents, it's clearly not just some rounding error. It means the foundational costs of forging your product have completely outpaced your financial projections. A 530 basis point drop in a single year is a massive structural warning sign. So show me exactly where the capital actually went.
Well, the cost of revenue surged 17% year over year to $651 million. Think about that for a second. When your top-line net bookings are dropping by 2.6%, but your structural costs to forge that revenue spike by 17%, your profit margins just get crushed in the vise. A 530 basis point drop means the fundamental unit economics of their gaming portfolio weakened substantially this quarter, and a highly concerning chunk of that cost surge came from one specific, pretty catastrophic operational failure. $43.4 million. Okay, that is a very heavy, very specific number just sitting on the expense sheet. What exactly did management spend over $43 million on that drove their margins down so severely?
Well, they didn't spend it on something that's going to generate a return on invested capital, I'll tell you that. They spent it on a project they ultimately had to throw directly into the scrap heap.
This is what we call an impairment charge. Take-Two took a $43.4 million write-down this quarter because management simply decided not to proceed with an unannounced game from a third-party developer.
So, let me get this straight. They poured over $40 million of shareholder capital into a third-party game, realized somewhere along the line that it just wasn't going to work out, and basically had to light that capital on fire.
Precisely. An impairment charge is a permanent reduction in the value of an asset on the balance sheet. In this specific case, it represents a very real crack in management's pipeline execution and quality control. They allocated heavy capital to a project that ultimately failed to meet their internal standards. That decision completely destroyed $43.4 million of shareholder value in a single quarter, and it serves as a major reason why they posted an 18-cent loss instead of that projected profit.
And unfortunately, the financial bleeding doesn't stop with just that impairment charge. We're seeing massive inflation in software development costs and royalties too. In Q1 of last year, these costs sat at $30.1 million. This quarter, they skyrocketed to $135.1 million. That is literally more than a 4x explosion in core development expenses.
Okay, but is that just the expected cost of doing business when you're heavily investing in building massive generational games like GTA 6, or is this actually a sign of unchecked corporate bloat?
Look, some of it is absolutely the heavy lifting required for their upcoming slate. But as analysts, you simply cannot ignore the sheer scale of the increase. When development costs explode like this, it acts like gravity pulling down your free cash flow conversion. Every dollar spent on bloated development is a dollar that cannot be returned to shareholders. If they can't control these costs, even a highly successful game launch is going to see its resulting profits severely diluted by the massive cost it took to forge it in the first place.
Section 3. Segment and Platform Headwinds. Okay, so the margins are cracking, capital has been written off, and development costs are soaring. But what about the actual platforms generating the revenue? Is the foundational support of their business at least holding up under all this pressure? It's a decidedly mixed bag. When we analyze their specific load-bearing revenue pillars, we see one pillar really doing all the heavy lifting right now. Console revenue surged 16.3%. That represents fantastic structural strength for their traditional gaming segment. But the weakness lies pretty much everywhere else. Mobile revenue is down 4.9%, and PC revenue plummeted by 13.5%. So console is basically desperately trying to offset the bleeding in the PC and mobile markets. And considering they spent over $12 billion acquiring Zynga to build out their mobile presence, a 4.9% drop there is a massive operational headwind. Why is mobile suddenly suffering so much?
Mobile is facing serious structural headwinds that are absolutely threatening the return on that massive Zynga investment. First off, net bookings for the mobile segment actually dropped 6.7%. Management blames this on difficult year-over-year comparisons, specifically pointing out that last year they enjoyed a massive, totally unexpected hit with a game called Color Block Jam, which they simply couldn't replicate this quarter.
See, that just sounds like a classic corporate excuse. Saying, we did too well last year, so this year looks bad, isn't exactly a sustainable long-term strategy. What else is actually eating into their mobile segment's profitability?
It's the harsh structural reality of user acquisition costs. Buying mobile ads to get players to actually download games is getting incredibly expensive across the entire industry, and that's largely due to privacy changes in the mobile ad ecosystem. This dynamic is actively squeezing the margins on their mature Zynga titles. If these user acquisition costs remain elevated, this vital revenue pillar will continue to weaken, which is going to drag down the broader portfolio.
Section 4. The GTA 6 and NBA 2K engine.
So despite all these structural cracks we've identified, we absolutely cannot ignore the two massive titanium engines powering Take-Two's future growth thesis. First, we look at their solid foundation. NBA 2K26. This game delivered an absolute masterclass in execution. They reported 12 million units sold, representing 9% unit growth year over year. But more importantly, recurrent consumer spending, which is the absolute lifeblood of modern gaming profitability, jumped by 7%.
Right. We know they are burning cash in some segments right now, but the bull thesis relies entirely on these specific properties. I'll give them credit here. Recurrent consumer spending is that steady, predictable cash flow that actually pays the bills. An increase in in-game purchases proves that 2K has forged an incredibly durable, sticky live service model. It's an ironclad asset that really helps stabilize their balance sheet.
Exactly. It provides critical structural support. But as strong as the NBA franchise is, we all know it's just the appetizer for the main event. Here is where the real macro stakes lie. Grand Theft Auto 6. Management noted exceptional pre-order momentum.
But there are some highly aggressive structural plays being made here that investors really need to monitor. We are looking at an 80 base pricing model, strategically designed to push hardcore fans toward even higher-priced standard and deluxe SKUs. Furthermore, they orchestrated a highly unusual 6-hour trailer exclusivity window with Netflix, basically just to drive initial hype and dominate the cultural conversation.
Hold on. I have to push back on management's narrative here. An $80 base price? That is testing the absolute limits of consumer yield strength. Everyday gamers are already getting squeezed by broad macroeconomic inflation. Are consumers actually going to tolerate an $80 entry fee without a corresponding drop in overall unit volume? And that Netflix exclusivity window just feels like a marketing gimmick. I mean, pre-orders are great for headlines, but no retail units have actually been sold yet. Are they just pulling future sales forward into pre-orders, potentially leaving a massive revenue vacuum post-launch?
Section 5. Forging cash flow. That revenue vacuum is the billion-dollar question. Let's pivot to the ultimate stress test of Take-Two's financial architecture, actual cash flow generation. This is perhaps the most alarming operational metric in the entire earnings report. In Q1, Take-Two posted negative operating cash flow of $168.8 million. They are burning cash at a rapid clip. Yet, despite the severe Q1 bleed, management explicitly reiterated their full-year target of generating over $1.0 billion in positive operating cash flow. Okay, this is where the rubber finally meets the road. You can talk about pre-orders, hype, and trailer views all day long, but if the underlying business isn't forging actual cash flow, the foundation is eventually going to collapse. That is a massive, almost unbelievable structural chasm. How do you bleed nearly $170 million in Q1 and still confidently tell Wall Street you're going to forge $1 billion in positive cash by year-end? That requires absolutely flawless execution and massive sales volume for the next 3 quarters. If GTS 6 development slips by even a few weeks, that billion-dollar target completely evaporates.
And you know what makes that operational cash burn even more intense? This specific forward-looking number right here, $290 million. In the midst of negative operating cash flow, management just raised their capital expenditure guidance for the year to roughly $290 million. Why the sudden increase in CapEx? Well, they're planning a massive real estate purchase.
Wait, let me get this completely straight. They are actively bleeding cash from their core operations, their gross margins are compressing by over 500 basis points, they just wrote off $43 million on a dead game in their pipeline, and their strategic solution right now is to tie up nearly $300 million in real estate? Why are they buying buildings right now? That feels like a brutal misallocation of capital when they should be fortifying their balance sheet and hoarding cash ahead of the biggest product launch in entertainment history.
It's a very fair, hard-hitting question, and it adds immense financial pressure to the coming quarters. They're allocating capital and spending cash like a company that already has GTAV revenue sitting safely in the bank, even though the game doesn't actually launch until November.
Section 6. The verdict. Opportunity or trap?
So we've executed a complete structural teardown of the quarter today. We've analyzed the GAAP revenue versus net bookings discrepancy, the severe margin compression, the $43 million pipeline impairment, the rising mobile acquisition costs, and the highly aggressive operating cash flow targets. Take-Two is stubbornly reiterating an $8.0 to $8.2 billion net bookings target for the full year. That represents a massive 20% growth expectation. But as our analysis shows, every single piece of that structural growth target relies entirely on the flawless execution and timely launch of Grand Theft Auto 6 on November 19, 2026. The baseline portfolio, especially that Zynga mobile segment, is showing very real structural cracks. Because of this, the stock is no longer a diversified gaming play. It essentially operates as a highly leveraged, high-stakes bet on one single product performing flawlessly.
And that brings us to our final strategic question for you, the everyday investor. Is TTW an ironclad buy right now because the GTA franchise is simply too big to fail? Or is this a stock carrying a dangerous level of structural single product concentration risk, currently built on fragile hype, $80 price tags, and cash-burning operations?
Look deeply at the numbers we provided, evaluate the structural integrity of their balance sheet for yourself, and make your decision. Let us know in the comments below if you think the foundation will hold under all this pressure. Thanks for joining this Iron Financial Explainer. Keep forging a stronger portfolio, cut through the noise, and we will see you in the next structural teardown.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.